Reality.
Hello, hello, hello.
Hello, hello.
Hi there, guys.
Feel like I'm in a club here with this music going in the background.
It was pretty funky, no?
I like it. It's
Yeah,
a
yeah,
very chill out lounge.
figure out how to stop it.
That's always fun. It's like it sounds good, but I don't know what to do with it now. I have figured out that my dog really, really enjoys light jazz.
Oh, it stopped on its own. The magic of Daphne. Hey, and Golan's here. How you doing, Golan?
Hey, how are you guys? See all of you again.
Oh,
Carrie, I
still
haven't seen
playing.
you.
Hang on, I'm just gonna stop the music. Talk amongst yourselves.
All right,
Yes.
we can do that. How are you going? It's been a long time since I've
Yeah,
seen you.
it has been. It has been. Yeah, things are pretty good, back and forth from the Middle East and doing what we need to do.
Oh, wow. That's busy.
It's busy, concerning, whatever way you want to put it.
Yeah, I think all of the above.
Yeah, yeah.
It's the only way I can describe that is all of the above. Wow. And the,
Yes,
so,
but something's got to be done and family to be seen and supported and it's
yeah.
all, it's all the right place.
Wow, it's crazy.
Sorry, everyone. I'm not ignoring you. I'm just figuring out my laptop. I'm listening. I am. I'm dialed in trying to figure out why.
You're dialed in trying to figure out what's going on with your laptop.
I'll figure it out. We have 3 minutes. I'll figure
Well,
it
there
out.
you go. It'll be okay. You'll be okay. You'll do it.
Gladly.
No worries.
Talking
I
about the
was
dog, my dog decided to make a lot of noise in my space, so I'm gonna just take her out.
you're allowed. That's okay.
Excuse me, guys, 1 second.
There you go. I laugh. You get into doing one of these things, and then all of a sudden, everybody you know all of a sudden wants to call you. I like keep clicking off my phone right now because all these people are going, "Oh, let's just FaceTime. Let's just FaceTime." It's like not doing FaceTime right now.
So funny.
They
Um,
figure it's after hours. Why can we not bother you now?
I know. Well,
You gotta be free
they
right
don't
now.
they've never figured out the fact that, I'm self-employed, so you kind of business hours are a little bit different for the self-employed, I think.
All right, I've stopped dancing in the background and figured out the music. Sorry about that, guys.
Oh,
You were
good.
dancing and we didn't get to see that. That doesn't
Oh
seem
my, oh my.
That would have
That
been
was
a
everybody's night.
pro. It's a promo for taxation. That's excellent.
there you go.
What was that? Sorry.
So it's a good promo for taxation topics.
Yeah.
Oh, everybody loves talking about taxes.
It's a dream subject tonight with the dream team. How can you go wrong?
Oh, there you go. It's
Let them,
I find taxes interesting, but I'm a little odd.
we're safe, we're sound, and we're dry. Could be a lot worse, right? If you look at what's going on.
Oh,
100%.
1,000%.
100%. Well, um, actually, we're not 5 o'clock yet, but I think we have a great topic today. I know I say that every week, but I think every week we have a great topic, right? Because family law is just so interesting, and we're all in it. We're all family professionals, so it's always good to talk about various family law matters. And today is taxes. Today we're dealing with the financial aspect. So it's officially 5 o'clock. It's officially after hours. Welcome to everyone viewing, and welcome to Family Law Now After Hours. Today's topic, as you might have guessed, is tax implications of separation and divorce. Please note the purpose of the series is to discuss general information on separation, divorce, and other family law matters. And any information provided here should not be construed as legal advice. Please use the Q&A feature to submit your questions and comments. We really appreciate it. We love when our viewers are engaged. It makes our jobs a lot easier and it allows us to provide some real world examples as well. Um, And as always, if you have any questions regarding your specific matter, please either call our office or a lawyer in your area to book a consultation to receive tailored advice.
Better call Sal, right?
Yeah. No, it's a great TV show, by the way. I love it. I'm on the last season. It's so, so good.
Same here. Same here.
Anyways, everyone, to our viewers, please stay tuned until the end, as we will be sharing how you can schedule a free 20-minute meeting with one of our lawyers. Now for the introductions. On your screen, you'll see Carrie. Carrie is the founder of Fairmore Family Law Financial Solutions. Fairmore offers independent, fact-based financial analytics and settlement insights to individuals and couples working through separation and divorce. Carrie is an active collaborative process trainer, co-teaching the introductory program for new collaborative professionals and advanced level trainings for seasoned practitioners. She
Just
sits
on
on
that note, we
Yeah.
have training coming up, right, Carrie?
We do. October 21st is when we start. I think we only have a couple seats left though.
Let's put a link in the box. Sorry to cut you off, Joseph.
No, all good. No worries. Yeah, it's a great course. I took it myself last year. Very informative, and the instructors are great. And not because Russ is one of the instructors, and so is Carrie, but they're both great, and they're both very intelligent people, and you can learn a lot from them. Anyways, Carrie sits on the board of directors for York and Durham Collaborative Practice, and she is also the president-elect of the OACP, but I don't believe president-elect anymore, right? It's just
Oh, I
president.
am the president right now.
Amazing. Carrie has taught statistics. Exactly.
You have your own song when you walk into the room and
Yeah.
everybody's to stand up.
I expect that. Everywhere I go, I expect to hear that.
With a salute, for sure.
100%.
Carrie has taught statistics, research methodologies, and psychology at college and university levels. And in addition, Carrie has presented at conferences for the Ontario Association of Collaborative Professionals, Family Dispute Resolution, the Institute of Ontario Annual Conference, and the International Academy of Collaborative Professionals. Golan is an associate family lawyer as well as a certified mediator with over 25 years of legal experience. Golan was first called to the bar in Israel in 1996 and then called to the bar in Ontario in 2003. Golan has extensive experience in representing clients and negotiation agreements as well as trial work. He also has experience in negotiating with the authorities to advance a client's interests and has represented clients at various levels of court, including on appeals. Russell is the founder of Russell Alexander Collaborative Family Lawyers. With over 25 years of experience, he uses his knowledge and expertise to serve his clients in all aspects of family law and helps them in coping with the difficulties of separation and divorce, as well as the division of assets such as homes and pensions, and the calculation and enforcement of child and spousal support. Russ uses his experience to create unique solutions for each client to enable them and their families to move forward and supports them through the transition of divorce and separation. Russell has written 4 books on separation and divorce and is a fully trained collaborative practice lawyer. He speaks at conferences on collaborative practice, marketing, technology, and the law. Last but not least, there's me. I am a compassionate family lawyer, at least that's what my clients tell me, which is good, and I'm driven by a deep desire to support families through challenging times. With a background in commerce, I bring a strong negotiation, analytical, and critical thinking skill to my practice, and during my articling period, I've gained confidence in handling a wide range of family law matters. I emphasize active listening, clear communication, and empathy, fostering a comfortable environment for clients. As is Russ, I am certified as a collaborative lawyer with the Ontario Association of Collaborative Professionals, and thus I offer clients an alternative dispute resolution approach to avoid court. Outside of work, I'm a dedicated Toronto Maple Leafs fan. Season starts tomorrow, by the way, as well as the Los Angeles Rams, and I enjoy playing hockey and watching comedy movies. So with that, we have our introductions, and I think it's time to dive right in to our topics for today. And that actually starts with me.
Just a couple things,
Yeah,
Joseph.
go ahead, of course.
Want to welcome our audience and everybody watching live online on YouTube. Thank you for watching. Who the Leafs play tomorrow? Isn't traditionally it used to at least be the Habs, but not anymore, right?
So they are playing tomorrow. I think they are playing at the Bell Center tomorrow. Yeah, they are playing at the Bell Center tomorrow.
Yeah, that's the big rivalry, right?
It's a big rivalry. It's a big game. First time Max Pacioretty is playing in a Leafs uniform against his former team, so that'll be exciting.
I have to watch that one. All right, let's talk tax.
Back to tax implications. Anyways, there's always a question clients have with respects to their status changes and how that relates to their taxes and how that relates with the CRA. And often they ask, when and why do we have to adjust your tax filings? So when a person experiences a change in marital status, it is essential to inform the Canada Revenue Agency, CRA, about this change, and they ask for this change to be mentioned to them by the end of the month following the status change. So to provide an example, if the change occurs in March, then the notification must be made by the end of April. And individuals must notify the CRA if 1, they get married, 2, become common law partners, 3, if the parties separate for more than 90 days due to a breakdown in the relationship, 4, a divorce, or 5, if their spouse or common law partner passes away. So if separation occurs, which is primarily what we'll be discussing today, separation and divorce, individuals should wait until 90 consecutive days have passed before reporting it to the CRA. And upon receiving the updated information, the CRA will recalculate benefits based on the new marital status and adjusted family net income. And those adjustments will start the month after the status change. So there are several ways to actually update the marital status with the CRA, including online, by phone, by mail or fax, or on the tax return itself. And when you're updating marital status on the tax return, if it's filed electronically, the change will be processed simultaneously with the return. If it's filed on paper, it'll take approximately 7 to 8 weeks after the CRA receives the return, and changes can be made when filing using various methods, including on a paper return, through NetFile, or through a tax preparer or authorized service provider who uses e-file. However, it is really, really important not to wait for tax filing season to update this information, as changes in marital status can directly affect eligibility for certain benefits. And updating marital status is really crucial for tax benefits and credits. As certain credits, for example, the GST HST credit, as well as the Canada Child Benefit, excuse me. Both of those tax benefits may be influenced by marital status. So with that said, tax liabilities also must be considered, and if one spouse was previously claiming the other as a dependent, or if tax liabilities were shared, necessary adjustments, will need to be made. And each party will be responsible for their own tax liabilities going forward. And it really is important to consider how property transfers or support payments may affect individual income, So long story short, you have to change your filing status. It's really, really important. Anyone sort of any comments about that? Or they want to
Yeah,
jump
I
in?
just want to add a little caveat in there about the
Sure.
90 days. So if you're separated and but you're still living together in the same home, the CRA will not necessarily recognize you as separated spouses. What they do is they will recognize you as separated when you are living separate and apart, meaning you have different mailing addresses. That's when they'll start to reallocate things like your child tax benefit, those sorts of things. It's really important that people understand that there is a distinction of how the CRA is actually going to recognize your marital status. So you may have been separated, say in February, but if you're still living together in the same home while you're going through a process, the CRA may not recognize the two of you as being separated because you're still physically under the same roof. Just a little bit.
No, perfect. Thank you. Thank you. And that's why it's always great if you are going through the separation process, speak with a lawyer and have them work with your ex-spouse as well as their lawyer on drafting a separation agreement. That document is really, really important, and it outlines the key dates. So if there's ever an issue about when or if you're not separated, that document's a great reference point. Now moving forward, there's a lot of questions we get from clients about both spousal and child support and how that plays into tax filings and with respects to calculating of income. So I'm going to let Golan speak to us about sort of navigating the spousal support aspect and when and why to consider the tax implications of spousal support payments.
Thank you, Joe, letting me speak to this matter. Firstly, just to reiterate what you mentioned at the preamble to this program, a tax advice should be obtained from tax professionals. That should not be second guessed. There is the legal aspects, what we can provide in terms of the generality of how tax is being treated when we're talking about spousal support and child support. At the end of the day, your accountant should be able to advise you exactly how things should be reported, what forms should be included, etc., etc. In terms of the topic itself of what people used to refer to it as alimony, we call it spousal support in the legal jargon. There is a significant impact when one is talking about spousal support because of the way that the CRA is treating spousal support. So spousal support can come in various forms. For example, whether it's a lump sum amount that basically lump sum covers a certain periodic amount and put them into one amount that is being paid either prepaid upfront to get a global resolution, or sometimes it's being paid as a retroactive lump sum for money that was owed before the court order or the agreement was made, which means that to catch up with all the payments that were supposed to be paid, you're now paying it in a lump sum amount. That's one aspect of how a spousal can be made, and the most important one for tax consequences is the periodic one, the one that's the ongoing one, the one that is being paid on a monthly basis. And then what comes into play is the party's income and inclusion of these support payments as income to the recipient, while the one that pays the spousal support, the payor, gets to deduct the amounts from his income. So this is a very generic way of categorizing it, but it could be a very significant consequence to, let's say, the payor, if he's at a higher tax bracket and now he's getting to deduct a certain amount, then you can imagine that the refund or the allocation of the spousal support can reduce his income significantly, and therefore his tax liability from his total income for that specific reporting year. Similarly, it goes to the support recipient. Well, if the support recipient was really at a low bracket and he or she getting spousal support, it may jump them up to a certain other tax bracket that makes them liable for tax for the payments that they've received. If the lower the original income of the recipient, the less the tax implication would be. One of the other things, just to mention, sometimes people are thinking just of a specific spousal support, but I think what need to be clear here is that the CRA is looking at court orders and signed separation agreements. Very, very significant factors in order for all of this to take place and be considered in terms of whether you can deduct or it cannot be just a verbal agreement that just put it there, and there's got to be a whole process of paperwork trail, an agreement that has to be signed properly and or obtained by a court order that would explain what is the payment, whether it's a lump sum, whether it's an ongoing, etc. Another aspect of spousal support could be payments to third parties, and the CRA could recognize payment to third. What I mean by that is, like, for example, if one party has to pay mortgage payments, property tax, insurance, tuition for the children, those payments could be recognized as third-party payments that are spousal support in nature. Again, it's supposed to be either in a written agreement that is recognizing that, or a court order that would explain that this is the third-party payments should be considered as a spousal support and should be inclusive or deducted from incomes depending on the respective positions. That's the very general way of categorizing the spousal support issues and what's necessary to look at when one is paying or receiving spousal support. Thank you.
One of the things when somebody's receiving spousal support that they need to be aware of is that the taxation on those monies is for the year in which it's received. So if you have somebody that's in arrears of paying their spousal support, so they don't pay you for an entire year, but they pay you that full amount for in the next calendar year, it is payable in that calendar year, not for the year before. So even though they owed it for maybe say 2023, but they just paid you in 2024, you're going to pay your tax on it in 2024. So it's important that people understand it's the year you received it is the year that it is taxable in. It's not taxable if they owed it to you for the previous year, you wouldn't add it into your income for the previous year. So especially if you didn't receive it, you're only going to pay tax when you receive the funds.
That's periodic support. So you're receiving it regularly. You get it lump sum. It's a chance you can treat it tax-free, but usually the person paying it is going to want a gross up or some kind of adjustment, recognizing it's coming tax-free.
Absolutely. And so when we're looking at a lump sum payment, what we want to do is we're going to take some of those tax implications into consideration. So the tax savings for the payor and the tax payments that the recipient would have will adjust for that as well as time value of money. Receiving all that money up front has a bigger value than receiving it over time. So we want to make sure we're doing those small adjustments as we're going through it.
Bird in the hand, payer might lose their job. You've been prepaid your support.
You never know.
The other thing, when you're tax planning, you want to consider oftentimes one spouse needs a chunk of capital to buy a house and they don't have it. Spousal support isn't going to help it. So you could do blended settlement. You could do some periodic support with some tax consequence, lump sum, a big sum out, maybe 100 grand for a deposit, but gross that up, maybe 30, 40,000 and set it off against other assets. So you can really have some fun and get creative in terms of how you're going to manage the tax consequence and come up with creative solutions.
Well, it's that idea of giving a concierge solution for the family. So it's what works for that family specifically. And that's the great part about it, being able to do some of that stuff when you're away from court.
And you're going to want to retain experts like you see on the screen here. And certainly Golan had a great comment earlier. We're not dispensing legal advice tonight. We're just putting the framework out so you get an understanding of some of these concepts you want to consider when you're going through a separation and divorce. Tap on somebody like Carrie, talk to your tax specialist, get advice, figure out what's the best way you can maximize the result for your family, not just for you, but for your spouse as well. And the last thing you want to be doing is paying CRA tax that could potentially be not avoided, but not liable because you're structuring it in a certain fashion.
Absolutely.
100%. Now we've spoken about spousal support and the tax concerns and the tax liabilities surrounding child support are actually a little bit different. In Canada, child support payments are not considered taxable income for the recipient and are not tax deductible for the payor. And this means that the receiving parent does not have to report child support payments as income, and vice versa, the paying parent cannot claim them as a deduction on their tax return. And child support payments can impact eligibility for certain government benefits. It's really important to keep in mind. For example, the amount of child support received actually may affect the calculation of the Canada Child Benefit, acronym CCB, as well as any other provincial benefits. In this case, the Ontario government may provide. So, it's really important for both parents to understand, how these payments might influence their tax filings and benefit and eligibility. So sort of just to take away from that, spousal support is tax deductible and is can be claimed as a tax deduction, whereas child support it's not.
Part of that though is on your income tax, on your T1, so that's your general tax return. You do have to claim any payments that you're making or any payments that you're receiving. So you would still claim that you've received child support. You would not put it down though as a taxable. There's two separates. It says how much are you actually claiming, like you receive, how much are you receiving from the payor, and then how much is claimable. So if you're receiving both child support and spousal support, you're gonna, in the one section, you're gonna put all of it, but where it says how much you're claiming, you're only gonna put that spousal support amount in there.
Yes, exactly. Golan, Ross, any comments with respect to that?
I agree. There's so many ways to think about this, but you guys are spot on. And again, every family is different, right? Depending on your income levels, there's going to be different tax consequences. Child support is going to be neutral, but if your income is over 350, the guidelines may not apply. You may do a custom calculation. So there's a lot to play around with here.
Absolutely.
So we've spoken about sort of the support side of the separation, that dealing with both spousal and child, but property is a whole nother world. So there's certain times in which parties have to consider the tax consequences of dividing assets during a separation and divorce. Golan, can you speak on that for us, please?
Yes, thank you again. Well, one of the main the tax implications in family law has to do with support payments and division of property, or as we call this, equalization of net family property of the parties that are having to deal with the matter. This applies to divorce couples, and that where the equalization may come into play. And this is where the parties have to consider what's the best tax implication or the consequences that they'd like to see, considering, for example, exemption for principal residence. So in family, you can have more than one principal residence. As far as the CRA is concerned, you'll get exemption for one principal residence. What I mean by exemption is that whatever gain you made on the property that is designated as your principal residence is exempt from the capital gains or tax overall. Again, there is reporting that has to go with that. That I'll leave to your accountant to ensure that this is done. Similarly, there could be gains on other investments or real estate property that has a tax consequences. We heard lately about changes to capital gains and how that's going to be increasing. And that's where people but we're not talking about the TFSAs, the ones that are growing tax-free. We're talking about, for example, the T5s, the one that you adding to your not registered investments that have grown over time, and that benefits or that gain is subject to taxation. Again, all of that has to be properly evaluated, sitting with a financial professionals like Carrie or an accountant, as well as the receiving legal advice that would be a custom made for that particular assets division, and making sure that overall we're meeting the goals that we set, whether it's a combined goals of the parties or whether it's just looking after one's interest, depending on his tax brackets, consequences, what it would look like if assets are transferred in kind versus assets that being sold and has to be disposed. So, for example, if people are doing a division by way of transferring the RRSP, it may not be subject to immediate tax consequence, and the party that receives the the payments eventually will have to pay tax according to their tax situation, but it's not an immediate disposition for the purpose of tax payments. Other situation would be considered as a disposition that would require immediate tax. For example, if you're trying to pay an equalization amount by selling a real estate property, and that real estate property has really gained a significant amount over the years of marriage, then when you're thinking of, oh, I just gained 200,000 here, I can just transfer the 200 over to make that payment. Well, it's not really going to be a 200,000, because after you're going to be subjected to the capital gains calculations, it may end up being significantly less. So all of that has to be taken into account when we do the calculation, when we do the plan, and that's the reason that advice is really, really important in this area.
Yeah, I think when we're looking at dividing property, it is a matter of looking at each and every asset that is held and asking the question, does it have a tax implication? Is there a capital gain associated with it? Is there a dividend associated with it? Do we have to take into those considerations? Is there a contingent tax liability later down the road? One of the things that a lot of people miss, though, on tax consequences when dividing assets are capital losses. Capital losses are actually assets that must be considered as part of the property, because we can use our capital losses. They don't go away. We can use those against our capital gains in the future. So they actually are quite valuable. And we want to make sure that we're utilizing those properly and we're recording them properly when we're looking at property.
Yeah, what that comment gives rise to another hour after hours on a separate topic. Some people use capital loss to reduce their income and avoid support, and courts will often say that's not appropriate. You earned 20 million, you lost 18 million. You're going to pay support on more than 2 million. These are actual real life circumstances. They can get significant. The other thing we haven't talked about, and you can look at Saving the Golden Goose. We've got videos and podcasts on this subject. Our family-run businesses and other businesses, which carry a whole library of tax consequence, which will inform your lawyer's decision and the court's decision as to what an appropriate sharing of property should be, what income levels should be considered for child and tax support, child support, and spousal support. All these personal capital gains losses apply to corporations in terms of notional tax rates. So lots to unpack there. And again, that's a whole nother hour, but we're just flagging, not only are these individual considerations, but if you own a company or a business, that's another set of tax we need to consider when you're going through a separation and divorce. So we get to the correct result, which is sharing property in accordance with the Family Law Act and providing an appropriate level of spousal and child support.
Carrie, what about the intangible, assets, the intangible property, such as, retirement accounts and pensions? How do we go about that?
Well, depends on what they are. So an RRSP, or a registered retirement savings plan, they're very different than a pension. They're a lot more pliable and we can do a lot more with them, but all of them have a tax consequence. The difference is that the tax consequence is going to come through when you draw it out. I always look at pensions and retirement assets as being that thing where you're doing a lot of savings and a lot of financial growing, not only for yourself, but for the CRA as well. And so the moment that you go to draw on that for your living, the CRA goes, thank you so much for holding our money. We'll take our portion now too. They're a little bit rude about it. One of the things that I always get concerned about when people have, for example, RRSPs, and they decide to go through this process, and we've seen this in the past, where people immediately go, well, we have to get rid of everything, so I'm going to start selling my RRSPs. Please do not sell your RRSPs. do not take a tax consequence when you don't need to. So both pensions and RSPs can be divided on a tax neutral basis, not tax free, it's tax neutral. Meaning what you can do is you can roll over certain amounts of assets that you own over to your spouse. And it is a tax, it's a tax neutral spousal rollover. So for RSPs, it's a tax form called a T2220. It's really, really easy to do. The banks will do it all for you. It's really nice and simple. And you do that within 30 days of having your separation agreement. Super easy to do. Pensions are a little bit different. So we have our pensions valued depending on what type of pension, whether it be a teacher's pension or if it's a federal pension, they are valued very differently and in a different aspect, but they are available for sharing. They are available for providing payment for an equalization payment. When you use retirement assets, though, for an equalization payment, meaning we get to that bottom line number that says that spouse A owes to spouse B, we can use your retirement assets to pay that person. The difference here is that an equalization payment is a cash value payment and retirement assets are not cash valued. So what we have to do is we have to transfer with it the tax implications that go with it. So what we do is we have, for example, a pension worth $100,000. We will discount that pension for tax implications that we know that person's going to have to pay on it. And then if they're going to use a portion of that, let's say they're going to use 50,000 of that to pay their spouse, then we're going to move the deduction, the deducted value of the pension that we did. We're going to move $50,000 worth of the tax that goes with that monies over to them as well. That way, when the person goes to get that money out, they're getting the true value back. So if it's 50,000 they were to get on equalization, we need to make sure they're still getting 50,000 or as close to it as possible. So we move a tax implication. It's also called a gross up. Does that help? Clear as mud.
All right, let's pretend we don't know what we're talking about for a minute, which isn't true, but there may be some audiences out there.
Okay.
What's the gross up? Why do we do it? And what percentage do we use?
So percentage to start off with is the best answer for that is it depends. So it depends.
Of course.
Carrie, you're turning into a lawyer.
I know, it's scary. It really isn't, it depends. It depends on how much is there and how much is available. So $1 million pension that has $500,000 being moved over, that gross up is going to be very different than a $100,000 pension and only $50,000 being moved over. They're going to have different taxes. They're not the same. It's not a one size fits all. We do a calculation to make sure that we're getting as close to the value. I always say it's a retirement asset discount that we're applying for what we know will be the minimum amount of tax payable. And therefore, that's the best we can do. We don't have a crystal ball.
And even if you're off by 5–10%, that can mean tens of thousands or hundreds of thousands of dollars, right?
It can.
Moving, going from 22 to 42 in terms of a notional. This is why you want to get somebody involved, Carrie, an actuarial, one of our lawyers, to say, this is the ballpark, but we may need to get some more specific evidence because the number is too big, right? You're leaving $100,000 on the table. We need to get the correct number. We're not just talking about hundreds of dollars where it doesn't make much sense to pursue.
And the other thing we have to take into consideration, especially with pensions, is the pension still being contributed into, or is the person in pay? Meaning, are they already receiving their pension? And how do we divide that? It becomes a different situation.
And is there a life interest? And what's the tax consequence of that? And how does it affect equalization? Another $300,000–400,000 swing right there in that one question.
Yeah.
Maybe even more than that.
So that goes back to our famous answer of it depends.
Oh, for sure. And I know I have always clients asking, how do you determine the notional disposition cost of these assets? And there are some standard percentages that the lawyers do use in separation agreements, but none of those actual disposition costs are necessarily accurate unless you speak to a tax professional. So if you ever are presented with a separation agreement or at least the net family property calculation and you see that and you see that there are investments that are prone to contingent tax liabilities, if you see that there's a notional disposition cost associated with that, it's always best to receive tax advice and maybe even through an actuary on how that number should be appropriately calculated.
And your lawyer can ballpark it, right? You can agree on some of these numbers. If you're selling a house, you might be into it for 5 or 6 points for the real estate agent, a few $1,000 for your legal fees. You can take a look at your mortgage agreement, calculate what the penalty is going to be, and come up with, it may not be exact, but you might, on $1 million house, you might be out of pocket 75, 80 grand in notional disposition costs. That sets the ballpark. You can drill down, get the experts done, or maybe the parties want to agree. They're going to say, you know what? We're going to transfer the house. We're going to agree on disposition costs, save that money. And they're entitled to make their own decision, but it needs to be an informed decision.
Yeah, 100%. And Carrie, we're gonna send it back over to you. How do you when you're presented, when you have clients, knocking on your door, how do you maximize their tax credits and deductions? What are the
Oh,
things that you do?
yeah. So this is always interesting. So first of all, it's that idea that don't just go and split your stuff. There is a tax efficient way of doing so many things. So for example, you have investments. So you have, say, a mutual fund. It's a joint mutual fund that you guys are just saving into, which is great. Don't just go and start cashing it out. You can actually do a spousal transfer on that too. You can divide it out. You guys will keep your capital gains or capital losses will be reallocated to you by your financial institution. So you're not actually having to pay the CRA for gains or losses that you actually haven't received yet. So we want to do that. Again, with the RRSPs, we don't want to be cashing those out and having to take a massive tax hit. We can do those on spousal rollovers and transfers that are tax neutral, and we're not going to get that hit right away, which is a great thing. The other thing that I always tell every client's couple to do, file your taxes together with or use the same accountant to maximize your tax credits, especially if you have kids, because you know what, if you're in a shared parenting, there may be credits that one parent can get that the other one can't. So the whole idea is maximizing family wealth. Your accountant will know how to do that. So don't leave money on the table because you want to be spiteful or silly like that. Just go and get the best deal that you can, especially with the CRA. I don't know about you guys. I hate paying the CRA. They just make me really sad every time I have to write them a check. So why, like, if you can get money back from them, let's get money back from them. One of the things that I need parents to be really, really careful about, and I see this in a lot of separation agreements, is when their kids are off to university, they talk about how either mom or dad will claim the tax credit from the child going to university. And I need people to understand it's not your credit. It is not for you. You cannot actually put that in your separation agreement. That university tax credit belongs to your child. And that if they choose to sign it over to mom and dad, that's their choice. But most parents, I would say, let your kid keep that. It can carry over for the first few years that they're actually in their job, get them some reductions so they can get some money back and maybe pay you back for some of their education. Who knows? But just to be careful about little things like that. Also, I always tell everybody, the CRA is the CRA and they will change things annually. So what may be acceptable today may not be acceptable tomorrow and vice versa on that. So although we want to give you the best that we can tax-wise and making sure we're doing this, At the end of the day, if the CRA says no, the CRA says no, and it doesn't matter what it says in your separation agreement.
For sure, for sure.
Always good news.
The
On
CRA is
that-
the boss.
that happy note, let's go to our next topic.
So we have clients always, and obviously they're paying us for our services. Golan, what legal expenses related to separation and divorce are tax deductible? Tax deductible, excuse me.
Yeah, so obviously, after people are spending their money on the various issues that may be involved in a breakdown of their marriage or separation, it could be the divorce itself, getting divorced itself. It could be the expenses for obtaining support for one of the spouses. It could be obtaining support for the children. There's also the topic of the equalization that we just spoke about. So when the bottom line, or how the CRA is looking at things, is what money had been spent in order to generate money. So that's what you're paying tax on, right? Like that's what you're getting deduction for. So if you have a business, if you ask yourself, do I have a business and I have to, I have to travel that long in order to generate that money at that location, do I get to deduct the expense for the travel, the expense for the computer that I'm working on, etc. So it's very similar to that, but the only thing that you're actually getting a money that is taxable is the support payments, and the support payments are those who getting money for the support, like the recipient, is the one who actually spending money in order to generate income. Because we said before that the spousal support, assuming that it meets all the criteria that CRA accepts, and it becomes an income to the recipient, meaning that they have to report it as an addition to their regular income, that means that they have to pay tax on it. So the money that was spent in getting that extra income is the portion that is deductible, and that is the legal fees portion that's deductible. So if a certain amount is not getting a deduction for the whole amount, but rather the portion that was spent on that specific area in order to generate that extra income. So if we're saying, for example, roughly that we had to deal with these 4 topics that I just mentioned earlier, and we'll say, okay, roughly here, we could say that 25% was spent on that topic. But generally, if you want to go into more accuracy, you actually go into the dockets and you look at the overall time that was spent on the spousal support issue, whether it's motion to go to court, correspondence, etc. Many times it's intermingled with others, so you have to kind of make your best assessment of things. And what we do is we provide confirmation to the client who spend the money to indicate what is the estimated amount that was paid, that was spent on legal fees for that topic of spousal support. That can be used with your income reporting and be deducted from your income overall.
Yeah.
It's not the same for other areas. Like I said, divorce, the spending on money on getting a divorce is not money that is not legal fees that would be deductible to you.
Great point. Sometimes, clients will ask me for a letter for CRA, say, this percent of my fees was spent on the issue of support. Strategically, that's important though. If you're pursuing a claim for support, that's the benefit your client's going to get if she's successful, right? She may spend 20 grand and be able to deduct a portion of that. If you're defending that claim, you don't get a deduction. You got some wiggle room to make a deal. You say, we can have 2 years of litigation. You're going to be out 50 grand. We're going to write it off. There's $100,000 spread. Maybe there's some wiggle room to make a deal on support. Just trying to get creative, right? This is a tax fact that you can employ as strategy when deciding how you're going to negotiate a resolution. You can get pretty creative with this too.
True that.
No, 100%. Russ, being creative, you're on that topic. Client comes to you. How would you tell them to be creative and in their ways about implementing, the post-divorce tax planning aspect?
I just gave you one example, right? I guess a couple things you want to think about is the filing requirements. So, and eligibility for tax credits are going to change potentially. Carrie's great at forecasting that. Say, here's what you're going to be looking at with this level of support, with your current income, now that you're not living together. You're oftentimes, for the parent with the child, their tax credits go up because their household income goes down. And that could actually reduce the spousal support entitlement or obligation because the pool of money is greater. One thing to consider, you guys had a great discussion of child support and spousal support, how those are going to be taxable, non-taxable, and when working out your budget post-separation. Great discussion tonight about capital gains. So you want to plan that out in advance, know what that hit's going to be. You don't want to make a deal and realize you're now on the hook for a capital gain, which wasn't factored into your separation agreement, and you're out of pocket. Potentially wiping out all or some of your equalization payment could be a real shock, real sticker shock. The reassess your income and deductions, RSP contributions, TFSA contributions, depending on your income, your eligibility may go up or down. That's something you're going to want to consider. Withholding tax installments as well, right? If you're a self-employed individual and your income's dropping or going up, or if you're a regular employee receiving a basic salary and you're hit with a support order, a spousal support order, you may want your payroll department at your company to start adjusting those deductions right away because you're going to get a tax deduction at the end of the year. You're going to find that's going to be coming off your next paycheck. And all of a sudden you got $20 to get you through the next 2 weeks. I'm not kidding. This actually happens. The tax liability wipes out whatever income was available for you. So you may want your payroll department to start making these adjustments up front as opposed to waiting next year when you get your tax refund. That's not going to help you meet your bills today.
Keep in mind though, Russ, with doing that, you do need permission from the CRA for your payroll department to lower the taxation that they withhold. So it's a really simple form that you fill out. You put in, this is how much child support I'm paying, this is how much spousal support I'm paying. I would like relief. They will send you a letter back. When you get that letter back, you take that to your payroll department and that gives them permission, and it has your permission in there as well. Keeping in mind, the higher your income, the greater the likelihood is that they won't allow you to do that. So you have to be careful. This, again, it's the CRA and they may say no.
And oftentimes this is pursuant to an interim or permanent separation agreement or court order. So it's information you can provide to the CRA as well. Great tip, Carrie. Final tip on this point, Joseph, update your beneficiary designations for your RSP and TFSA and get that cleaned up post-separation. Lots of other things you need to update, but in terms of taxes, that's low-hanging fruit that can be done pretty easily.
Thanks, Russ. We do have one question from the audience. Separation agreement's been signed, parties are not yet divorced. I'm assuming the person asking the question, how can I protect myself from tax liabilities incurred by the other spouse after date of separation? Anyone want to take a stab?
Sorry, you've got a separation agreement that's been signed?
Yep, so a separation agreement's been signed.
The agreement should be saving you harmless from, these type of actions. So that's one. The big risk if you have a spouse who's running a business with HST and other tax liabilities, and CRA decides to take a super lien and jump creditors, that's going to be a big problem. So you're going to want to make sure that you're well protected and you get the appropriate releases. What would you say, Golan?
Absolutely. Firstly, the key is the separation agreement. Since the gentleman or the person who's asking the question had done it already, hopefully it was not done without a proper advice and legal advice. Standard, like you mentioned, saving harmless and ensuring that each one is following the signing of the agreement is responsible for his or her own taxes, whether it's through a self-employment and or other things that may be owing. All of that should have been transparent before the agreement had been signed. So whether there had been a expectation of maybe a tax contingency or liability that may be coming, sometimes in the future, hopefully it would have been had been time. But otherwise, the agreement is the key to ensure that this reimbursement or saving harmless, as you mentioned, is in play, and that would be the shield that would guard him from any sort of liability that may be flowing from because they're still married, and there may be still a jointly and severally liability for taxes on certain things because they are married legally. And then this is where the separation agreement is your statement of defense in a sense. This is your ultimate defense. So agreements are not just to put in the drawer. It can be useful eventually.
Perfect. Thank you both for your answers. And while we're on the topic of audience engagement, we're getting the questions from the audience. Thank you. Keep them coming. Carrie, I'm sitting here, I'm watching this webinar, I'm listening to everyone speak. When is the time for me not to sit on my hands? When should I be coming to professionals and seeking clarity and understanding really the tax implications of a situation me or someone else I know is going through?
I think from the beginning, the faster you kind of get on top of it, the easier it is. And the most importantly, the more options there are open to you. Sometimes we leave things too late. People start selling properties. So if you have multiple property, they go, well, we're just going to sell all of this without understanding the tax implications, or maybe not even understanding fully if somebody can keep a property so that you're not actually having to go through some of those problems. The idea that if you have multiple houses, maybe somebody is going to be moving into that house and that's going to become their primary residence. So there's different things that we want to look at. So the faster you get into somebody and start talking to them about the situation, the easier it is for us to kind of give strategy. It's easier for us to give recommendations, and it's easier for us to be able to help you navigate through this without paying a whole lot of money to the CRA.
One of the services is really quite popular in our firm is, for lack of a better phrase, we call it pre-separation legal advice. So you're not even separated yet. You're thinking about it, but come and get some pre-separation legal advice and include questions about all these tax liabilities and strategies that we're talking about this evening.
That's a great point. That's a great idea.
Well, we used to say, you fail to plan to fail.
Yeah.
There
I
you
like
go.
that one.
Is that your military background coming in?
we have so many that we've been living off of them throughout the service just to get through it. So a lot of things are.
They beat that into you, right? You never forget that one, yeah.
Yeah.
Serves well, though, when you're in trial or motions court, right?
Hey,
even something
this is where we say, difficult in training, easier in the battlefield. That's what we do when we practice and do what we do, and then we come to the battlefield, which is the litigation court for us. This is where we excel.
You take that one step further for our audience and potential clients. Plan your meeting with your lawyer.
Mm-hmm.
Write your questions down. Oftentimes, I'll tell, even in point form, just so you can, at the end, you're going to be probably a little bit overwhelmed. You may forget a few points that you want to bring in. Pull out your piece of paper, go through them one by one and check them off. A lot of times I'll get somebody say, oh, I forgot to ask you one more question. No problem at all. We'll answer it, but plan for your appointment. Get the copy of the court order, get the separation agreement, get some of these maybe your tax return and some business records, so your lawyer can make a more informed recommendation when you're having that first meeting or doing this pre-separation legal advice that we're talking about.
100%.
Absolutely, much more efficient way to conduct meetings and save money.
Have a plan or plan to forget your questions and be doing a second appointment later.
Gonna cost you more.
100%. We are getting to a close to this seminar. However, I know that everyone here is eager to discuss some real life scenarios that they've had the pleasure of dealing with on a day-to-day basis. And I'm going to start with the big boss, Russ. Russ, what have you seen in your practice over the last 25 years that you can heavily relate to our conversation today?
If you want to learn more, go to our site, look at Runaway Train, look at Saving Golden Goose, look at all these other podcasts and webinars we've done. We've spent hours on this. This is a quick overview tonight. We're giving you a flavor of some of the things you want to be considering. If assets out of country or in the United States, certainly, a lot of things you want to be considering are the different tax rules, the tax treaties, the reporting requirements of each country. There is a popular Canadian hockey player who's going through this. He got a signing bonus. I thought he had paid his taxes properly in the US. Now, CRA in Canada wants a little bit more of that pie.
You're not going to name them, Russ?
No, I'm not going to name them. But, this is a professional following professional advice, and there's still a dispute over what the outcome could be. It could be in millions of dollars. So, like Golan said, have a plan, follow your professional's advice, tax and treaty and rules and reporting when assets and income cross the border are very significant. Don't just assume if you're living in New York State, paying income to a recipient in Ontario that your tax treatment is going to be the same. So consider that. In terms of case studies, the links I just mentioned will give you hours of information. Carrie's participated in most of those, if not all of those presentations, and so has Golan. We have cases that involve Panama Papers where super sensitive CRA was focusing in on this area. Anybody with assets or investments traveling or staying within that region were subject to audit, and really heavy reporting and document requirements from CRA, which is Canada Revenue Agency. Corporate restructuring can trigger a tax audit, something you want to be mindful of. We've got cases where we did not restructure the corporation. We did not want to expose this family to a potential audit. Although academically in law school, it makes sense to do it, there is tax consequence to that choice. So if you're not mindful of that tax consequence, it's just the idea of unknown knowns or blind spots, you're going to walk into this agreement and a line, the tax landmine, and may come off in a year or two when the government tax authority catches wind of the transaction. And then you're going to be looking at interest, you're going to be looking at penalties, you're going to be looking at the cost of refiling. Much better to get it right at the front end. What are the tax consequences if the business continues and the separated couples continue to own this business? Oftentimes, properly so, personal expenses are run through the business and deducted. Are you going to share those personal expenses? If not, what tax treatment are we going to give that? So business owner continues and it writes off personal things, but we need to consider that for spousal support because his income is higher, because he's getting this tax deduction in a different tax bracket. Lots of thinking you want to go, or if they're going to share those expenses, you want to make sure that that's properly documented and executed by the corporation. You want to look at corporate reporting to those two spouses on an ongoing basis. So these transactions can be reviewed on a regular basis if there's not a lot of trust between the two spouses. And I think, there's so many case studies. We got corporate issues that I've mentioned briefly, you're going to want to bring in corporate lawyers to give you advice, not just your family lawyer. Family lawyers are sort of like the general contractor when you go to build your house. The general contractor may not be an electrician or a plumber. We're not corporate lawyers or tax lawyers. We certainly can bring experts in to deal with that specific issue. But you're going to want to make sure you have the right team, especially if you're a family that's quite wealthy and there's lots of heritage to that business and you want to continue. This is what we call this golden goose. This company is going to continue to provide for this family. You want to make sure you get this tax planning and strategy done right. Legacy planning is important. What's going to happen when a business owner dies? How are we going to wind up this company in a tax efficient way? What if the business owner repartners and that partner wants to make a claim to the assets? Is your first agreement going to be bulletproof? Are you going to ensure that that business owner enters into a domestic contract to respect the sanctity of your original court order and separation agreement? And where are these assets going to flow in a tax efficient manner? Is it going to be the new spouse, the former spouse, the adult children who may be working in the business? Maybe they can do some kind of restructuring. Should it be a family trust? Again, each one of these topics I'm talking about is one more hour of information. This is just a flavor of some of the case studies you want to be considering. But I'll certainly open it up to the floor because really the list can be endless. Thoughts, Golan or Carrie?
I thought that you more than covered everything that could be, by doing all sorts of breakdowns of family relations. Like I said before, if you're not sure, just phone up and get a consultation, get the advice that you need, and go from there on every topic that has to do with the family breakdown and the consequences of it, whether it's the taxation, property, etc. So I think that you really you covered all of these contingencies and what can happen and the resources available for our audience to consult free and by getting a proper consultation with any of us.
Call Sal or call one of us. Carrie or Joseph, any thoughts?
My only thing is that going through this process is a highly, highly emotional thing. It's also one of the biggest financial transactions you will ever do in your life. So take a moment, don't do things that are rash. Just get the advice, talk to people, whether it be somebody from my office, from your legal office. Just talk to somebody that is a professional in the field so that you're not having tax consequences that you didn't mean to have because you didn't know. We're all there. We're all willing to help.
And if you make a mistake, don't worry. We're going to help you fix it. Don't stick your head in the sand and hope it's going to go away. Come get help from a professional. It's okay. It's normal. This is what we do.
Absolutely.
I think that's a great way to sort of end our session today. Thank you to, first of all of our panelists. Everyone is so knowledgeable, and I always am in awe listening to everyone. And I'm making my own notes on the side as we're all talking today because you never know everything, right? So it's always good to keep learning and to take away from the knowledge the three of you have. Those tuning in on YouTube as well as in our Zoom today, thank you so much for tuning into Family Law Now after hours. Following the session today, a brief survey will appear, allowing you to share your comments and suggestions for future topics that you'd like us to explore. And as always, your feedback is greatly, greatly appreciated. Again, thank you for sticking around until the end. And to take advantage of this opportunity for a complimentary 20-minute meeting with one of our lawyers, make sure to register by noon this Friday. And you are going to provide the code, same one as last week, because it's a big day tomorrow, Leafs 2024. That's LEAFS 2024. And you're going to send that code to Nicole in our intake department. She can be reached at Nicole, NICOLE, at russellalexander.com. And that's when you're scheduling your appointment. Registration is also open for our next event, our next Tuesday after hours event, Understanding and Drafting Separation Agreements. It'll be a really, really great session. To register, all you have to do is just go to russellalexander.com/family-law-now. Again, thank you to our panelists for sharing their insights today, and thank you, the viewers, for tuning in, and we really appreciate it.
Joseph, wonderful job tonight. Hope you don't give any PTSD to Habs fans who want to call it. I think we should have a Habs 2024 backup code just for this week only, because we got a big game with the Leafs. So
We can meet in the middle. How about we don't discriminate against Habs fans? If they want to come in, if you're a Habs fan, if you're a Leafs fan, you're still gonna get the same 20-minute consultation.
and we're
And
going to give
the
the
same great legal advice.
same
Quality advice.
right. But we're not licensed to practice in Quebec, just caveat. So Ontario clients. Carrie, fantastic job tonight, as always.
Thank you.
Golan, wonderful, so insightful. You guys did a fantastic job. I really do enjoy this, and I learn a lot just listening to everybody. It's really wealthy, really great resource. I want to thank our audience too, and our audience live streaming online. You make us do this. You keep turning out and asking these great questions. So it's really nice to see everybody engaged.
Thank you for having me. Thank you, Joe. Great job. Thank you, Ross and Carrie. Always
Thank
nice to
you,
see you.
Thanks,
everyone.
guys. Have a great night to everyone viewing and to the panelists. Have a good evening, everyone. Thank you.